So welcome to yet another episode. And in this episode, I basically want to address some of the key things that you need to really understand and look out for when you're trading gold. The reason I'm doing this video is because there is always a lot of hype when it comes to trading gold. Every beginner coming to the forex market, they say that they're coming to trade gold, yet they don't understand how gold moves, the things to look out for, and then because of the high volatility of gold, a lot of them end up blowing accounts, and they end up quitting in forex, right? And maybe probably if they really had taken time to understand gold, or maybe probably begin with a less volatile asset, they could have maybe probably sustained in the financial markets. Okay. So, but also the reason why I'm doing this is also to shed light in terms of what I usually look out for, the things that I normally look out for me to be able to trade gold consistently, right? So, and one of the key things that you need to understand with gold is market characteristics, all right? The market characteristics of gold. Number one is volatility. You need to understand that gold moves more than most FX pairs, all right? So, if you do your research well, you realize that the daily range for gold can range from 200 pips to 500 pips, all right? This is the range, all right? This is the range that we are talking about. So an average range of 200 to 500 pips on a daily basis. So this means risk management is very critical, right? This means that risk management is very critical, okay? Risk management, it's very critical. And we can be able actually even to see the same. If I look at this is the gold chart. If I look at the number of pips that the price was able to push yesterday, from this level to this level, we are talking about 381 pips. Okay, so the range is between 200 to 500 pips daily. Okay, so that is the daily range. So it's quite volatile. And anytime we talk about high volatility, then risk management is no brainer. You have to really manage your risk well. Then there is the aspect of liquidity. It is very highly liquid, right? It is very highly liquid, and but it can move fast on news. Okay, so it is highly liquid, and also it moves very fast, especially when we have high impact news, right? Then the other market characteristic is that gold is considered as a safe haven. So in times of uncertainty like wars, crisis, recession, gold usually gains as investors flock to safety. Like right now, we are having a lot of uncertainties with the dollar. We are very bearish with the dollar, right? The dovish sentiment by the Fed, and we have been seeing gold really appreciating, right, pushing higher. So anytime we have that kind of things, the time we had Russia attack Ukraine, gold pushed all the way up. The moment we saw Israel and Iraq, right? So the prices of gold really skyrocketed because gold is a safe haven, right? So investors tends to flock into safety and invest in commodities like gold because of its the safe haven characteristic. Okay, so the number two thing, number one, we have talked about market characteristic. Number two is fundamental drivers, right? Fundamental drivers. You need to understand that gold doesn't trade on just technicals, okay? Gold doesn't trade just on technicals, right? So you must watch the big picture. And the big picture here, we are talking about number one, the US dollar, that is the DXY. So you understand that gold is inversely correlated with the USD. So anytime we have a strong dollar, it usually means weaker prices for gold, or that is bearish sentiment for gold. Anytime we have a weaker dollar, then it means it's a bullish trajectory for gold. Like you can see, this is the DXY. We have been bearish, right? We have been bearish with the DXY. It has been bearish, okay? It has been bearish. If you look at the gold chart as well, right? If you look at the gold chart, that is gold chart, you'll find that it has been bullish. Okay, it has been bullish because of the inverse correlation. So it has been bullish. Like you can see here, the prices of gold have been bullish, right? They have been bullish. Okay, so you need to understand that. The other thing under the fundamental drivers that really push the prices of gold is the interest rates and the Fed policy, right? So when the rates rise, gold usually tends to drop. Okay, and that is because when the interest rates are high, it means higher yields compete with gold, all right? Higher yields are competing with gold, which doesn't yield interest, all right? Which doesn't yield interest. So I want to look at the interest rates. I also want to look at the Fed policy. Like I gave a scenario right now that I'm recording this video. Last week on Friday, we had Powell, who gave a very dovish sentiment, a likelihood of the Fed cutting the interest rates, which jumped all the way to 85%, right? Likelihood of the rates being cut in September meeting, which will be held, I think, September 17th. Okay, so and we saw gold skyrocket, and that what we have been riding actually even the entire of this particular week, right? Even the entire of this particular week, that's the trend that we have been riding on, the bullishness, right? The bullishness began from here on Friday 22nd. That's the bullishness we have been riding on even until now. That dovish sentiment by the Fed. The other thing under the fundamental drivers is the inflation data. So you find that high inflation boosts gold demand as an hedge, because anytime we are going to see inflation increase, what it does is that it creates the aspect of gold now being even a more safety haven, because there is some economic uncertainties. Prices of goods and services are going up. There is high inflation. So people don't want to keep their money in form of fiat currency. They want to invest in safe havens that always appreciates, that are likely to appreciate maybe during that particular time, safeguarding their money from being devalued. All right. So the inflation data is something that you want to look at it, but remember, there is that instant reaction of the price when the data is released. Like for instance, if the CPI data is released, which measures the inflation in the US, because gold is traded versus the dollar. So we have a strong CPI. What that means is a strong dollar, and that strong dollar, therefore, will make gold prices to push on the downside. Okay, that is the short term when you're trading those kind of spikes. Okay, when you're trading the news release by themselves. Okay, so I did a video about trading the fundamentals. Maybe I will put the video in the description of this video, so that you can the link of the video in the description of this video, so that you can watch and understand what I'm talking about. So geopolitical event is another fundamental driver when trading gold. Things to do with wars, elections, financial instability, they often push gold prices higher. I want you to go and look at when we had the different elections that we have had in the US. Look at maybe since the last 20 years, then backtest the same in the Forex Factory calendar and see how gold prices react. Those instances that we had were like when Russia first attacked Ukraine, right? I remember the prices of gold were about 19 something, and we saw the price rise all the way up, right? Go and backtest and look at those scenarios, okay? The other thing is the US treasuries. You want to look at the US treasuries, like maybe for instance the 10-year yields or the 30-year yields, and you need to understand that gold moves opposite of both yields. So if the US treasury yields are pushing down, then gold is pushing up. If the US treasury yields are pushing up, then you'll find that gold is pushing down, okay? Because it moves the opposite of that. These are the correlations that you want to understand, so that you can be at a better position in terms of knowing what to trade and how to position yourself. Okay, so for economic data, always keep a look on the CPI, the NFP, the FOMC, the PCE price index. Like what we have today, we have the PCE price index. Maybe in a couple of few minutes at 3:30. And these events will often move gold massively. You'll see gold moving massively during these type of events, okay? So number three, remember number one, you've talked about market characteristics. Number two, you've talked about the fundamental drivers. Number three thing is now the technical analysis. And the technical analysis, you need to understand that gold respects technicals very well. especially when you are looking at maybe levels of supply and demand, when you are looking at the order blocks, right? If you're trading the ICT, looking at the concept of the order blocks, like what I trade, and all those other strategies. So the key things that you want to look out, because I'm not here preaching to you. I don't want to preach to you that ICT is the best to trade gold. No, people even use support and resistance. They make money with gold because it respects the structure. So the first thing that you want to do is to understand the market structure, right? The previous video uploaded was about the market structure, about or some things that you want to understand, the language of the market. How does the market move, right? So you also want to understand the structure of the market. When you look at this pair, when you look at this gold, right? So here you are seeing we are in a nice uptrend. The price is pushing up. Okay, the price is pushing up here. All right. So this is a trend, right, that has been holding prices pushing on the down on the upper direction. We cannot have it like this as the best line of it like that. Okay, so you see that. That is what has been holding the prices of gold pushing on the upper direction, right? That trend line, okay? So if you come this particular level here, you'll also see those kind of scenarios, plenty of them, right? Plenty of them. So they will guide you because gold tends to really appreciate in terms of, to respect these structures, right? If you look at this, actually, you realize that it's an engulf, it's a channel, right? You see that is a channel, okay? That's a channel, right? That's a channel that the market has been respecting here. So that is the market structure. So some of the key things to look at, or some tools that work best, you want to look at the key levels. That is the psychological levels, like the 1900 levels, like the 2000 levels. Like you can look at right now we are talking about the 3400 level, all right, this level. You see the moment gold broke above this particular 3400 levels, right? These 3400 level, it has been unable to break below that particular level, all right? It has been holding up. So this is a psychological level. So next we are looking at maybe probably that 3450, all right? So 3400, 3410, 3420, those are some of the psychological levels that we are looking at, okay? So the next one, the major one we are looking at is the 33,500, where we have the all-time highs, all right? Where we have the all-time highs. So the other key thing to look out is the support and resistance. Gold loves retesting, loves to retest the broken levels of support and resistance, all right? Like in this particular zone, what we have here, this is a level of resistance that has been broken, and we see how gold is coming to retest here, and we are seeing some bullish trajectory, kind of rejection from this particular point, okay? So the other thing, you can do the Fibonacci retracement and extensions, all right? So if you look at maybe probably yesterday getting this kind of a sell buy here, so if you take your Fibonacci from the lows here to the highs here, you find how the price comes to these Fibonacci optimal trade entries, all right? The optimal trade entries, and it gives you some very nice entries from that particular level, okay? So you can look at it in different parameters, different aspect. If you're looking at this selling trajectory here, you see how price is pushing from that particular point all the way to the lowest point here that the price reached, and then now it is retracing to these Fibonacci retracement levels, all right? The Fibonacci retracement, the optimal trade entry levels here, and then now you have your nice sell on the downside, okay? So that is very key. It's very optimal to look at Fibonacci retracements and extensions, especially the 50%, 61.8%, if you're using the normal Fibonacci. But if you're using the ICT Fibonacci, you want to look at the OTE level. That is the optimal trade entry levels, right? So to understand how to use Fibonacci, I did a video, two videos actually, one for the normal Fibonacci, the other one for the ICT classic Fibonacci, showing you how to do the setups and how to position yourself in terms of trading. So I'll put the links in the description of this video. Go and watch them and practice doing that. So the other thing is the market structure, okay? So gold really respects the market structure. Like you can see in this kind of a market structure, Here we are pushing up. It's creating series of higher highs and higher highs, okay? Higher highs and higher lows. So you want to look for buying opportunities only here because it's an uptrend. The moment the market retraces to these levels, you look for buys. Retraces, these levels are the ones that you want to look for buys. Pushes up, retracing. These are the levels that you want to look at for buys. If it's a selling market, the same scenario, right? The market is creating series of lower lows and lower highs, okay? So when the market pushes down, then retraces. At these points, that's where you want to align yourself in terms of looking for sells, okay? Pushes down again, retraces. You look for key points of interest that can be able to give you a sell. Pushes down, retraces, okay? So you align yourself in terms of the structure that, in terms of the strategy that you use, okay? So the other key concept is the smart money concept. That is the CMC or ICT. And this is in respect to liquidity grabs, order blocks, fair value gaps, which are extremely effective when it comes to trading gold. Okay. So like you all know, you've followed me for some time. I always use the ICT order blocks. That has been my strategy. That's how I usually look at my gold setups. All right. So, like for instance, here I remember today morning in our live analysis, we are looking for this potential buy here, whereby we have seen the market push up because this is an order block, right? So I usually use the ICT order blocks for me to be able to eyeball my entries. Like yesterday also we had this particular setup here, right? This is an order block, so the price pushed up to created this BOS, okay? Created the BOS here, then now pushed down again, retesting the order block, and now we take a buy, which was a very successful buy, okay? So, the smart money concept, that is actually been my strategy. That's how I look at gold. And when you're trading gold, you can even, because of the volatility, I usually go to as low as 5 minutes time frame. If my order block in the 5 minutes time frame exceeds 50 pips stop loss, then I go to the 5 minutes whereby I'm able to refine my setup, okay, where I'm able to refine my setup, maybe probably to minimize it now from 50 pips. I mean, from maybe 60 pips, I bring it maybe to 50 pips or below, okay? So those are the key things that you look at in terms of technical because it respects the market structure. And those are some of the key things that you can look at and try to align them in terms of the strategy that you use, okay? So number 4, best time to trade gold. That is very important, okay? So what is the best time to trade gold? Okay, that is the big question in the room. What is the best time to trade gold? So you need to understand that London and New York session are very volatile. We have volatile peaks during those sessions. So you want to trade gold during the London and New York session. Sometimes also the Asian session do move gold, but I actually try to avoid gold as much because sometimes it can really consolidate in the Asian session. Sometimes it can really consolidate in the Asian session. No much moves, no much volatility, but sometimes it moves. Like you can see here, it really moved a lot in the Asian session. Okay. So, but mostly I focus on London session and more specifically on the New York session because of the aspect of the dollar. Okay. So, I avoid the Asian session unless maybe probably I'm looking at scalping ranges. All right. I'm not looking at maybe very long-term position because you find that most of the time gold tends to consolidate during that particular hour of the day. So also you want to look at news releases like the CPI and FPFOMC. When those high impact news are being released, gold usually creates a lot of big spikes, and therefore that's when we have a bit of high volatility. And when you're trading news, of course, you have to be cautious because of the high volatility of gold. It can easily mess you up in terms of the direction or in terms of those spikes. So you have to really check on your risk. Okay. So those are the best time that I would usually advise for you to look at in terms of trading gold. Then number 5 thing is risk and money management. Okay, position sizing. When you talk about position sizing, you need to understand that gold's volatility can really wipe you out if you are over leveraged. A small pullback with you being over leveraged can really take you out. Like if you look at this kind of a pullback, as small as it looks, this kind of a pullback, this is about 131 pips. So you can imagine if you are buying high here and then we have this pullback. So this is enough to take you out, maybe probably you losing more than you could afford to lose. And the reason why now I'm saying that you really need to look at your position sizing. Okay, so look at your position sizing, lower your risk well. Trade smaller lots than you hold on FX pairs. If I do trade, maybe for instance, Euro USD, I can do a position of 0 0.5. So if I'm trading gold, therefore, I will be able to do a position of 0.1. I have to reduce my risk significantly because gold is very volatile, very much volatile compared even to the FX pairs. Okay. So then you need to use stop losses. Always use them. Place those stop losses beyond the liquidity zones, like I've always shown you. So if I'm maybe probably trading the CMC or the order blocks. So if this is my order block, then my stop loss will be slightly below the order blocks. All right, it will be slightly below the order blocks. So the other thing that you need to understand is risk per trade. So when I'm trading gold, I don't risk more than 2% of my capital. And because gold sometimes is volatile, depending on the volatility, there are times that I go with 1% risk per trade. Okay. I look at the 1% risk per trade, and that's what I trade to because I want to really conserve my capital in the markets for the best time so that I can be in the market for the best time possible. All right. So the other thing is patience. So you need to be patient, especially with gold, because gold will test your emotions with fake outs and stop hands, especially when it's consolidating. Like today, you can see here the price trying to push higher, then pushes down again. So you have to really be patient because it really tests, gold is one of the assets that can really test your patience, all right? It can really test your patience. So you need to understand the fake outs. You need to understand the stop hand. You need to be patient to wait for your strategy to unveil 100%. Okay. Then number six, trading strategy. All right, trading strategy. So you need to come up with a unique trading strategy. I've given you the tools to look at. So with those tools, you can derive a strategy, or maybe probably you can learn a few strategies, test them out, all of them, and see which one will be able to work for you. Of course, when you're testing them out, you're testing in a demo account. All right, you're testing them in a demo account. So make sure that you test them and you're in a position now from your journal, you're also testing them and journaling them. And from your journal, you're able to understand which strategy fits for you. You can do the trade following, whereby you use higher time frame structure like H4 daily, then define entries on M5 and M15. A break and retest, very reliable on gold, especially if it breaks a level of resistance. The resistance becomes support. It's very reliable. You can look at that as well. Maybe you can use the concept of the liquidity grabs. So look for stop hunt above or below the obvious highs and lows before the price reverses. Also, you can look at the supply and demand zones because gold respects the order blocks very well, because supply and demand and ICT order blocks, they're just but the same. Only the entry criteria, a few things that really try to change out slightly. Okay, but everything else is just but they are just both than almost related. Okay, so they are different that you can be able to look at. So I don't want to be like I'm proposing to you trade the way I trade. I trade the ICT order blocks. So maybe that one might not sync for you. Test them all. ICT order blocks, supply and demand, test the breakout and retest, check the trend following, and see what works for you. Of course, you'll be able to understand that if you are journaling your trades. And lastly, number seven, traders psychology. What is your psychology? Okay, don't chase the moves. If you see gold, maybe probably you're waiting for gold here to come here so that you can buy, right? And now it has come almost that point and start going up. And then now you, because you're trading from a point of formal fear of missing out, you jump for buys here. No, don't chase the moves. Not only gold, anything that you're trading, let the price come to your point of interest. Okay, not you going to the price. It is the price that should come to your point of interest. Okay, so that now you can avoid trading from a point of missing out. because you understand, especially for gold, if you chase these moves, you know that gold often pulls back deeply before continuing. So if you chase the moves, then you take a wrong entry. Therefore, it will definitely get you out. It will definitely knock you out. Okay. Then accept that you won't catch every move. And this is where most of the traders go wrong. You don't have to trade each and every setup. You don't have to catch each and every setup on gold. If it leaves you, well and good. Look for another entry. There are so many opportunities, infinite opportunities in the market. You don't have to trade today. You can trade tomorrow, the day after tomorrow, and you are trading only when you are convinced this is an A plus setup. What is an A plus setup? This is a setup that has been able to to respect your trading plan. Confirmed setup that is well aligned 100% according to your trading plan. Okay, and you have used maybe probably a checklist to confirm that indeed this setup has met all the conditions of my trading. Okay, and then now you take a trade. Like for instance, if you look at this order block, it has met all the criteria that I look at. I have a BOS, then I come and mark the order block. I had marked this from the 5 minutes time frame, all right? So the BOS there, then this is the order block. The price rallied, created a BOS, then came back to retest this BOS during what? 905, which is during the kill zone, the New York kill zone. Therefore, that trade is valid, all right? It has met all the conditions, all right? Then with my checklist, I have to confirm the risk is 25, about 26 pips, 27 pips. Okay, so it's not more than 50. Then will it be able to give me a risk to reward ratio of 1:2? All right. So then I place it like that, how I want to have it. My stop loss there. Then of course maybe probably targeting these liquidity levels here. And if I look at that, risk to reward ratio is 1:5. Okay. For me, I actually go for 100 pips. I don't want more than 100 pips. So 100 pips is around this particular point there. Okay. So that is where we have 100 pips. All right. And that's a very nice setup. It has confirmed. Okay. So focus on high probability setups rather than constant scalping. Avoid constant scalping on gold. Okay. So focus only on high probability setup. Let the price, okay, let the price come and pick you up, not you following the price, not you going to where the price is. Let the price come and pick you out. Okay. So in summation, what I've been able to share to you is seven. I've shared with you seven key things to understand and look out for when trading gold. Number one, the market characteristics of gold. Number two, the fundamental drivers. Number three, the technical analysis. Number four, best time to trade gold. Number five, risk and money management. Number six, the trading strategy. Number seven, trading psychology, your trading psychology. Okay. So you need to combine the macro awareness, that is the dollar, the Fed, the inflation, the yields, the geopolitical, with precise technical execution, that is now looking at the levels, the structures, the liquidities, the supply and demands, the order blocks, while maintaining a strict risk discipline. Okay, while maintaining a strict risk discipline, because gold only rewards the patience. Prepared traders and punishes the overtraders. So it rewards the patience and prepared traders, and it harshly punishes the overtraders. So don't overtrade. And that's the reason why I only look at 2 to 3 setups, right? 2 to 3 setups for gold on a weekly basis. So that tells you I'm looking at about 300 pips on a weekly basis. That's all I want. I don't want more than that. Okay. That's all I want. Okay. So with that, ladies and gentlemen, I believe you found it insightful. Make sure to comment on this video, anything that you might want me to clarify or look at, any questions you have, anything that you want me to do a video on, comment on that on this video's comment section, and I'll be able to look at it, answer you if it's a question. And until next time, always remember to trade with purpose, to be disciplined, and always remain focused in the financial markets.